me straight and narrow
You
here.
are now live.
We are now live. Okay. And call this meeting to order. Tell them I got it, that we're live. Um, and this is Senate Finance. And uh, today we are very thankful to have Michael Costa with us. We've been talking about the most recent tax commission study, but Michael actually staffed, I think maybe did a lot more, with the first, at least in my memory, blue ribbon tax commission study. And Michael, and we got a whole slew of tax proposals today in the governor's budget message, which is we're going to get a briefing on tomorrow. But we thought it would be very helpful for you to just go over with us, because some of us weren't in the Senate, some of us weren't on finance. Why the Blue Ribbon Tax Commission was put together, what your charge was, what solutions you brought out, and what, if any, progress we've made on those solutions. So thank you. I really appreciate you taking your time out of your real job these days to come talk to us. So I do appreciate that.
No, delighted, Senator. So for the record, Michael Acosta. I presently serve as Chief Executive Officer of Northern Counties Healthcare. We are a federally qualified health center and Medicare certified home health and hospice agency serving the Northeast Kingdom, with sites in St. Johnsbury, Concord, Danville, Hardwick, Orleans, and Island Pond. And I think last year our home health agency drove just over 300,000 miles. So it has been a long way from the Blue Ribbon Tax Structure Commission. I have to tell you, and I don't want to waste the senator's times, but the Blue Ribbon Tax Structure Commission might have been one of the most important things that ever happened in my whole life, because it gave me the impetus to move from California back to New England and to move to Vermont, which was kind of a cherished dream that I didn't think would come true. And now, 11 years later, we're here, happily living in the Upper Valley with two kids at the Marion Cross School in Norwich. So it played a really pivotal part in bringing me back home, and for that I'll forever be grateful. That said, it has been 11 years, so I would beg the committee's indulgence, but some of this is a little bit in the cobwebs of my mind, and I'd appreciate committee members steering me in the direction that you want to go, because I want to make sure that I'm helpful in my recollections of the previous tax commission's work. When I picked up the story, it was in 2009. I believe at the end of the 2009 legislative session, the legislature, the General Assembly passed a law that said, it's time for Vermont to review its tax system. There was a considerable amount of discussion about whether Vermont's tax structure was understandable and competitive with other states. I can't help but notice that every single tax conversation in Vermont features three things: a noun, a verb, and the state of New Hampshire. So there's always been a lot of discussion about Vermont's tax system. And it sort of, that law asked for a soup to nuts review of the tax system. I came on as the staff member in January of 2010. At that point, the committee had been up and running for a couple months, being staffed by the Joint Fiscal Office and Sarah Teachout. And it had three members: Kathy Hoyt, who had served in the Dean administration, Bill Schubart, and then also Bill Sayre. All three of them were extraordinary people. I'm so grateful that they came to that commission with an open mind, that it was a public service and one worth doing well. Where the committee spent most of its time was trying to take a look at the tax system and make sure it understood where we're at and where other states are at. And then it did a series of things. Number one, it felt like it had an educational obligation. And so it found that many discussions about tax policies have this tension between perception of how you think things work and then how things actually work, which I'm sure the Senate Finance Committee deals with all the time. And so there was a section in the report on key findings about Vermont's tax system, so we could all start on the same page. From there, the commission really dug deep on recommendations for how the system might be improved, including restructuring the personal income tax system. And I do think the legislature has made a fair amount of progress on some of the recommendations in that report, broadening the sales tax base to include services and other things beyond the traditional goods, trying to find a rationale for tax expenditures, which play a huge role as a shadow sort of tax system where certain things are exempted, and then investing in tax policy resources, like in various types of modeling. And then furthermore, one thing that happened in the middle of the discussion was instead of being a review of the entire tax system, it was broken apart into two pieces, which is education taxation and everything else. At a certain point, the legislature decided that it was too big of a thing to do all at once, to do the entire tax system, including Vermont's education property tax system. And so that was split off, and the commission really focused on the core tax, personal income tax, sales tax, etc. When I look at that, to my mind, the commission's work was generally well received. Certain tax trade publications that were very kind about it being kind of a return to kind of an older school, like real commission approach where it wasn't about the politics. It was about trying to find the right answer and about trying to really figure out where Vermont stood compared to other states. I know that's the way. I so appreciated that the Joint Fiscal Office and the members of the General Assembly and the commission members themselves all approached it in that way. And it turned out to be just, from my perspective, a really helpful exercise. When I look back at it now, 11 years later, I think in broad terms at the 75,000 foot level, the recommendations about personal income tax and broadening the base a little bit, some of those have been taken. One good example is the state and local tax deduction got limited to $5,000 at one point. And so some effort has been made there. There's been a lot of work around tax expenditures. I remember this committee spending a lot of time trying to make sure that, one, everybody understood the purpose of a tax expenditure, and two, giving some thought about whether the juice is worth the squeeze for those tax expenditures. And then a lot of work has gone into the analytic capability of the state of Vermont to think about who pays taxes. So I think that has been all very positive. I think where it is struggled is where many tax reform conversations have struggled. Expanding the sales tax to services. Boy, tax professionals and tax theorists and tax attorneys have been talking about that for decades. And it is simple. It is as simple in theory as it is hard in practice, because you'd have to move, that you'd be changing a lot for people. And so I think that has traditionally been a really tough slog for public policymakers. And then, of course, Vermont's in a pretty challenging tax environment, at least, in my opinion, because it's next to New Hampshire, which has a really different tax system. And I think the specter of New Hampshire, makes things a little bit more complicated. This is the point where I say what I should have said up front, which is these are just my personal views and recollections from this work, and has nothing to do with my current employment. But if asked to be helpful to a legislative committee, I'll always say yes and try the best I can. Education, now, I did mention that the work split off, that it ended up being about the sales tax and the personal income tax, and the education tax work was put off. That is true, but that doesn't mean the committee didn't do anything on the education property tax. There was a lot of modeling that went on, over a dozen different models that the Joint Fiscal Office and the Commission and the Tax Department worked on together to figure out what other options were available for education financing. Everything from pulling apart the income sensitivity system to moving to a full income tax in place of the property tax. So basically going to an adjusted gross income system. And so a lot of modeling was done on that, a lot of work was done on that, and in the end, I think the commission chose to, with the backing of the legislature, focus on areas where they might gain consensus instead of going further into the education property tax work, because while the modeling was helpful, it seemed unlikely that the commission was going to be able to get to the end of the road on that. That's my recollection, but of course that was a while ago. I know I'm talking almost as fast as Mark Peralt, who I have fond memories of. And so with that, I'd be happy to stop and either take questions or allow the committee to steer me in a direction that would help them. As you consider the most recent round of tax reform proposals.
Committee, Senator Bray, you have a question.
Yes, please. Thank you, Madam Chair. Michael, I don't want to disappoint you, but you're going to have to learn to talk a lot faster to catch up to Mark Parole. One of the I think you might have used the word jarring about moving tax on into services. Was there ever a discussion of sort of letting the clutch? Well, and part of the impetus, as I remember, was if we included services, we were actually going to be able to drop the rate more generally, right? There was enough more revenue coming in that we could lower the rate like 6 to 3 something. And I'm just wondering if it could be, now I don't think we have that opportunity, it's my understanding that, but before getting stuck in the details, I think what I'm wondering is, was there ever any discussion about adding a tax on services, but not at the full sales tax rate, so that it's, that's what I mean, letting the clutch out. So it would be less jarring, but start to build a broader base.
Yes, and perhaps I should have summarized the committee's work a little more fully. But a lot of tax reform efforts focus around this concept of broadening the base and then lowering rates.
Right.
That was very specifically the conversation around the sales tax. The committee played with various models about what to include in the base and how to drop the rate. My recollection of it was that at one time, if you included basically everything in the base, all services, you would have the opportunity to drop the rate from 6% to about 3%.
Right.
Over time, as the committee started talking about the equity of taxing certain things and not others, it started to kind of poke holes in that modeling. And it landed in a place where the rate kept going up, first to 3.5, then to 4, and then 4.5. And there was sort of the discussion at that point of, well, could you really do this? If you could only drop the rate a point or 1.5 would people find that acceptable? And so I think there are a lot of, as this committee is well aware, there are a lot of hard public policy trade-offs in there. But the idea with both the personal income tax and the sales tax was broaden the base and lower the rate. In the initial discussions, we're trying to cut the sales tax in half because committee members at the time felt like that might enable a conversation where people were open to exploring a broadening of the sales tax.
Right. And I think it feels like we've evolved to a place where the rate decrease, if any, would be so modest that we would get all the grief associated with expanding the base, and no points, no appreciation for any kind of drop if it's only a point, for instance. I don't know that we're looking for points, but it makes it easier to engage your colleagues, that kind of thing.
I would say my memory is that when the commission was looking at this, they had chatted with policymakers in Florida and Maine that had taken a hard look at this now many, many years ago. And it kind of fell apart in the same way. The initial look at it allowed for a rather substantial rate drop. And as things, got more complicated, the rate would rise, and then it created this feedback loop. I mean, in all of public policy, you kind of have this dynamic where there's really only two types of public policy, simple or fair. Like when it's simple, you could drop the rate. As it became more fair and targeted, the rate moved up and it became much more difficult, both for the politics, which I leave to other people, but also just the equity and understandability of the system. Like, is the system really a coherent tax system if you're starting to toss out this service and toss out that service?
Yeah.
Right. And so a lot of states have settled on this sort of taxation of services where you kind of tax people that aren't going to complain too much about it, right? Which is not really a coherent way to approach sales taxes.
Yeah, thank you.
Senator McDonald, do you have a question?
I think it perhaps was just answered. Was the reason that the rate was not able to be dropped in half because various services were finding ways to lobby the commission not to be included in the tax of services?
I would let the commission members speak for themselves. I think that they really valued consensus Like, where could all three of them agree? And I think the closer they got to making a recommendation, the harder it was to get agreement on taxing certain services. And at that point, things just kept going up and up. I've worked for elected officials in Massachusetts, Wisconsin, California, and Vermont. Vermont, for my money, it is unlike any of those other three states because it's still really a good faith dialogue about what the right policy choice is. It makes it really different than those other states in a way. And so I don't recall a lot of lobbying, although there could have been phone calls and emails I wasn't aware of. It was more of a, hey, are we really going to do this? Are we really going to find consensus on a much more aggressive proposal? And I think it was hard to maintain consensus on that as they got to the finish line.
Okay. Senator Brock.
I know that the work of the Blue Ribbon Tax Commission focused on the income tax and on consumption taxes, and you didn't really get to property taxes. What do you think you might have missed by not being able to do that? And how did not being able to do that impact the results of the report itself?
So just this is an outstanding question, Senator. Just my personal opinion on it, missed an opportunity to explain clearly the trade-offs in the current system. Generally in life, if you're explaining, you're losing. And I like tax policy, and I really am fascinated by Vermont's system. And the moment someone references the CLA, I'm like, oh no, we're now like really deep in the weeds. And I think there was just an opportunity to say, hey, you had this political compromise, from what I understand, because I didn't live here at the time, because some people wanted to maintain a property tax and some people wanted to implement an income tax. And it's really this double bind where it really depends on what your fundamental assumption is. Like, should it be an income tax for education or should it be a property tax? And so I think the commission missed an opportunity to explain those trade-offs and how it worked in a simple way. I know there are people in this committee, particularly Senator McDonald, who can really clearly explain the education finance system, but not every Vermonter understands it in that same way. And then I think that modeling would have been an interesting jumping off point for the legislature. If you could see a dozen models that said, hey, here's what it would look like just as a property tax and where the winners and losers would be, because any tax reform discussion inevitably gets to the issue of winners and losers. And here's what an income tax surcharge would really look like. And so you could get to that sort of factual place instead of people's assumptions about it. I just think that would have been useful for the legislature. I think they made the wrong decision at the time? I don't know, because they were trying to land this sort of aircraft, right? But I think that putting that out there in a public way could have been really useful for people.
Well, we are going to be doing that this year, and hopefully we'll be able to dust off some of those old runs and see what you had. I know there's been new runs done for the new tax commission. So we're going to be taking a look at all of it. And yeah, I'm interested in what it looks like under different scenarios.
The final report doesn't speak to it at all.
Right.
And in perusing the Joint Fiscal Office website, I'm not sure that the real final version of that report exists anywhere, because the one that I saw has some formatting issues that I know we wouldn't have tolerated. But there are presentations from the fall of 2010, most specifically September and October, that lay out all those different runs and say, okay, assume X, and here's the Y results. And so, okay, if you go, here's what the tax rate would be if there was no more income sensitivity. Here's what the income tax would be if we eliminated the education portion of the property tax and go to an AGI-based system. And there are about 14 flavors of ice cream, but it's all concentrated for your staff's purposes in the fall of 2010.
That is very helpful. Thank you. We will start searching the archives. Okay, Senator Brock, did you have another question?
Well, it might be helpful, Michael, too. As you know, there was a majority report and then there was a minority report. What are the significant differences that appeared in the minority report that were not in the majority report?
So just refresh. Let me just refresh my recollection here. So what Senator Brock is referring to is that the commission stayed together for a really long time, and then ultimately they were not able to get consensus among all three of them, although they worked in a wonderful way and really collegially. And so there was sort of a majority report that Kathy Hoyt and Bill Schubart had put out, and then a minority perspective where Bill Sayre kind of thoughtfully laid out viewpoints on various issues in the tax code. And I think my recollection is that the minority report, it kind of had a broader viewpoint of what what we should be taking a look at. There's a lot of focus on competitiveness, economic development, trying to encourage people to move to Vermont, which are issues that remain very, very relevant. But I would have to go and reread. I read a good portion of it, but I would have to go and do a little bit of analysis to be able to answer that fully. I think it went more towards like a flat tax, right? And trying to really lower that income tax rate, because that's for as all of you know all too well, the rate that people see on the page really affects kind of how they view the tax system. Whatever the effective rate may be, whatever people might actually pay, that top line number. So my recollection is that with concern about competitiveness and Vermont's place in the region and trying to attract people to live here, there was a real focus on trying to drop that rate and to make it more flat as a way to signal that Vermont was going to be more competitive. There's also some issues around the estate tax where Vermont can be out of step with certain other states on the estate tax, which is a big policy choice. So I think there was some discussion of that as well, which I think was a broader scope than what the majority wanted to take a look at. I'm sorry not to be able to answer your question more fully.
Yeah, I think that's good. We are going to be looking, I think, at a flat tax at the property tax level. So we'll see where
Well,
that.
the one thing, it was a very good set of studies, both what the majority wrote and also Bill Stair did a very thoughtful commentary about alternatives in the minority report. And I think it would be useful for us to try to understand them, at least at a high level, because it will help, I think, inform what we do when we look at the current Tax Structure Commission report.
Yeah, Senator Brock, the word that went right to the top of my head when you brought up Bill Sayre's piece of the report was thoughtful. He put an extraordinary amount of effort into discussing that, and I just thought it was really helpful for people to see how the commission itself kind of tried to work the issues and tried to go about that.
We'll trace them down and get them up on our website so that everybody can read it and refresh.
I guess one other thing that came up, but is perhaps not reflected in the report, though I'd have to comb it again to see if that's the case. One idea that was played with a lot was, hey, could you have a flat tax, which is kind of a loaded term for some people, but then could you use deductions and credits to make its actual effective rate very progressive? And I know they played around with that because there was such sensitivity about the fact that the number on the page is really high. So if you're seeing 0 in New Hampshire and 5 in Massachusetts and 9 in Vermont, there's a visceral reaction to that. There's an assumption about competitiveness embedded in that. And so there was an idea that maybe you could have a flat tax so the number on the paper is low and the same, but then you use a system of credits and deductions to keep much of the progressive policy choices embedded in the tax code. Because right now, Vermont has a really progressive tax code, but the top line number, it kind of like, there's a top line number, but very few people get up that way, right? And so, is there a more advantageous way to keep those policy choices while making a different signal about competitiveness? So I'm sorry if that didn't make much sense, but it was a thing that we tried to construct, but it ultimately kind of ran out of time putting it together.
I remember there was a lot of discussion that other states either allowed no deductions or you could take a flat rate of, was it $250 or something deduction, and we actually allowed a lot more deductions. when we redid the tax code after the tax cut and job bill, we did do away with most of the deductions, or at least a large, some of them. And I don't know if it's made any difference, but, and we did collapse the top two brackets. So we have made,
Yeah,
if it's progress or not is a judgmental word, but we have moved closer to the recommendations.
yeah, I think that the commission found, and I would leave it to the Joint Fiscal Office and the Tax Department to rerun this number because my knowledge of this is a little out of date. But it was the finding of the commission that Vermont had really high tax rates, but very few people pay them because of the series of credits and deductions. And that sort of masked some of Vermont's potential competitiveness, and that Massachusetts, I think at the time, had a 5% rate, but there's really no way to get out from under it.
Right.
And
It
so
was
you
across
might
the
be better off
board.
in, yeah, you might be
Maine
better
had a
off.
lower rate, but it started at $40,000. And actually, there was the tax rate in the tax bill, and Vermont's tax bill for many, if not most people, was actually lower. But when all those tax study put out their booklets, they report the top marginal rate, and that's where we look bad.
Yep. It reminds me of the one time I walked through Buck's Furniture. Those are high prices, but hardly nobody pays them, right?
That's right.
Senator Brock, you're
Brock,
muted.
you're muted.
I just remember during much of that time or earlier years where Massachusetts had a 5% flat rate. I worked in Massachusetts, lived in Vermont. Every single year I paid money to Vermont without exception. So the flat rate was not flat
Yeah.
in terms of how it applied in Vermont.
Okay, Senator Hardy. The newbie who has no memories of this.
Yes. I was busy with other things at the time this came out, but it all sounds extremely familiar because it feels like we have this conversation over and over again.
We do.
And we are going to have modeling of the property tax, income tax situation, and talk about it later this week. But a question, did the tax commission get into any kind of research as to whether or not tax rates actually impact where people move? I mean, a lot of people think it does, but is there any research data that shows that any individual tax rate is a compelling pro or con for life decisions about where to live?
So yes, the commission looked at that, and it came to two conclusions. Who knows what motivates individuals, but the data at the time was based on census data and IRS data, more people were moving into Vermont than were moving out of Vermont, right? Which cuts against the idea that wealthy Vermonters are moving out. Also, we did this really interesting data set where we followed people that made, I think it was more than $500,000 a year every year for 10 years. And what we found was it's more likely to be high income event Vermonters than high income Vermonters. I remember being in the tax discussion, it was, what are wealthy Vermonters doing? Well, there weren't that many of them, right? Because people might sell a business, they might sell a farm, they might have a lot of income for a year or two, but it was only about a couple hundred people that had high income every year over 10 years. And so the data that the commission found was that the tax rates, if they're causing people to leave, there's still more people coming in, and that it just might not be accurate to think of high-income Vermonters as a couple thousand people a year. It might be more accurate to think of them as a couple hundred people a year. And so do you want to orient your entire tax debate around a couple hundred people? I'm not taking a position on that. I think the commission was just saying to public policymakers, it's more complicated, and our perception of the debate may not be reflective of what's actually happening. And so I think, I will tell you though, and I hate to do this. Governor Shumlin was very nice to me, and I appreciated working for him. I remember telling him this and him saying, yeah, I see your data, but I don't believe you. So I think everybody has their own personal experience of who they know and what decisions they've made. And, and I can speak to my own life. My in-laws, are they moving to New Hampshire from Connecticut because of taxes? My father-in-law says yes. My mother-in-law says it's to be near their grandkids.
Yeah.
And so I don't, which one's right, I don't know. But the data, we did not find any compelling data that was the case, but I know that is a much argued over point in Vermont tax policy.
Yes, it is a much argued over point. I just had a recent conversation with the tax commissioner about it, in fact. So it will continue forever, probably, but thank you.
You're welcome. The only other thing, which I know you all know, but something that commission experience taught me, and then ultimately working on various iterations of healthcare financing and healthcare reform, is when you get into big picture financing discussions, be really clear about what problem you're trying to solve, right? And you could solve hundreds of problems. I mean, Vermont is tiny, but the problems all of you face as its citizen legislature are no less complex than huge states. And I always found that trying to figure out what problem you're trying to solve with the finance mechanism makes the discussion more direct and pointed to have and has helped.
Well, I think defining who is wealthy in Vermont has been an issue. I asked the tax department for a breakout, and either we have no billionaires or we have fewer than 10, because they couldn't tell me. And they can't tell me anything that had fewer than 10, but there aren't that many. And I think we know that 50% of the folks in the top tax bracket won't be there next year. So it's, again, it's what's fair or what's easy. And I don't know where it originated, but I know Representative Ansel says exactly what you did. The minute you try and make it fair, it becomes complicated.
She knows her stuff when it comes to the tax code.
She does, and continues to send us very interesting proposals. So, okay, Senator Bray.
The word has come up a couple times, and I wonder if the word fair has come up a couple times in our conversation today. And I don't know if the commission wrestled with this. One version of fair is something like treat everyone the same, and the other version, so like a flat rate. And another version of fair is everyone pulling relatively the same. So it's progressive. Did you, as a commission, try to come to a notion of what fairness, how you would define it?
My recollection is that, oh boy, and I think it's right in the report, they tried to wrestle with this notion of what's fair and what's unfair and how that is frequently in the eye of the beholder.
Yeah.
I think what my recollection is that they kind of pivoted around three things. One, people should be able to figure out what they owe, right? Everybody should contribute, but contributing should be in proportion to your ability to pay, right? And so I think that's where but they spent a lot of time talking about fairness. It was really interesting. I think that combination of three people were able to really chat about it in a humane way. And I think there were some disagreements at the table of whether a flat tax was fair or something else was fair. But I remember the three things they really concentrated on is you should know what you owe. You should have some skin in the game, though I don't love that expression. Because people contribute in lots of ways to make our communities better, and that you should pay in accordance with your ability to pay. That there was no desire not no desire. I don't want to overstate it, but your ability to pay should figure into it somehow. I think the commission did get stuck, to Senator Cummings' point. They briefly talked about a wealth tax, and I think they closed the door on that just because of, beside being states by and large don't apply wealth taxes, the administrability issues can't be waved away. Like trying to actually design and implement that would be really, really difficult.
Thank you.
I chuckled when you said fair is in the eyes of the beholder, because any parent has figured that out, which led to my mantra as a parent: you're right, life isn't fair and I can't make it fair. So deal with it. But tax policy is not life's, and that we can deal with. But yeah, it is in the eyes of the beholder. Fair is one of those words. Senator McDonald.
And on that vein, Madam Chair, my recollection, one of my recollections of the report was that when they looked at people in New Hampshire and they looked at people in Vermont, and when they looked at people with incomes in both states, and then they counted how many, what percentage of the population at the same income left New Hampshire to go to Florida at retirement time. And they looked at the Vermonters at the same incomes, at the same percentages that went to Florida at the same ages. And they asked the people in New Hampshire why they went down there. And they said, it's warm down there. And they asked the Vermonters why they went down there. And the Vermonters said, they don't charge income tax down there. But that was the only real difference between New Hampshire and Vermonters in their behavior. So I think that goes back to the mind of the beholder.
Well, New Hampshire doesn't pay income tax anyway, so it wasn't a change for them to go
But
to Florida.
But they were leaving and going to
because it was-
Florida at the
And I
same
understand
number.
that today.
Yeah. Yep.
As pretty as the snow is, it's cold out there.
They were not going according to
Right.
what they reported because it had anything to do with taxation.
Okay. Any further questions for Mr. Costa? Michael, do you have anything else to share with us? Insights. You're
No,
a free citizen now. You can say what you really think.
Oh boy, I don't know. I'm going to stick within the four walls of the report. The only other thing that I think there's lots that they talked about, but another real pivot point was, I think the commission understood that people really want to talk about the income tax, right? Like it's, hey, that marginal rate is something that really gets stuck in people's mind. But they also took a look at a lot of different research on total tax burden. I know ITEP and other groups do that, about, how do you stack sales tax and property tax and income tax together to figure out what a family is really paying. I think the legislature has done a really commendable job of thinking more and more about affordability over time. And total tax burden gets at that a little more. And so I think the commission really wrestled with, we know that everybody kind of wants to focus on the burning platform of the marginal tax rate over here, but there's a lot else going on as far as what people pay. And then particularly if you look at New Hampshire's tax, the distribution of New Hampshire's tax burden between car tags and this and that, it can end up being pretty regressive. And so they took a lot of work at that. I know it was included in the report. I don't know if it really ended up being shined a big light on it at the end, but I know it was a big piece of their discussion. Everybody wants to talk about this, but there's a whole, as this committee knows, a whole bunch of stuff that people pay.
I remember it being very thoughtful, very thorough, and very in-depth as just a study. And three people from very different perspectives that worked very hard coming together and putting out a report that was helpful. And we have made some changes. I don't know if Vermonters feel any better about their taxes today than they did then, but I think we're trying to do that. Property tax is the one I get the most complaints about. I think people that go to their accountant and he tells them, you're paying an outrageous income tax. But I remember with the last tax cut bill, people were really upset because they got $3 a week back in reduced taxes that weren't taken out, but they didn't get their $500 refund in March, and they planned on that refund to do something or go somewhere. So it depends on your perspective. But property tax you pay in a couple big lump sums, it hurts. And so committee, any other questions?
Madam Chair,
Yes.
I'd invite all the committee to attend the Rivendell budget meetings where they vote on their school budgets, because you get a chance to sit there and listen to
Right.
the New Hampshire residents in that school district offer their opinions about taxes and school and local education taxes. And then you get the Vermonters to offer their opinions. And it's quite fascinating how the New Hampshire people complain that the Vermonters' property tax, local education taxes are half what the New Hampshire folks are. And it's all a matter of, as you say.
I know when I was selling houses, the two states where people didn't go when they saw the property tax bill was New Hampshire and California. Other places, if you were coming from the South, you went into sticker shock, but not New Hampshire. So
They were the ones.
costs a certain amount, Okay. So committee, Senator Bray.
Before we say goodbye to Mr. Costa, I just wanted to let him know this report lives on. I still have it, read it more than once, and it's in my file. It's a great report. And I know things are dated, but it's really readable and helpful. So thanks.
Thank you. Thank you very much.
Thank you very much. And thank you for taking time today to be with us. We were trying to get just someone to talk to us about the tax commission, and you were the one person I thought that could give us a broad perspective and that we knew where you were and could reach you. And I really appreciate you taking the time from what has to be just a wonderful, smooth year.
I just remember, Senator, being in right field in Little League going and thinking to myself, someday I'm going to work on a tax reform commission and be a healthcare administrator. So
I'm sure.
It all worked out exactly the way I thought it would. Thank you.
I always thought I'd be
happy to help.
chairing the finance committee too. Okay. Thank you very much.
Take care. Good luck.
You too. Okay, committee. We are on to the impact of pensions on the ed fund. And, as we talk about delving into the tax structure and the tax structure commission, I'm kind of holding my breath because this is the first year ever. It's over 20 years that I am really concerned about getting our work done. We have a huge amount of work on our plate, and the governor just gave us second helpings of everything in his budget proposal. So we have an enormous amount of work to do. And we are going to keep slugging our way through it. So, Graham, I see there you are. Before anything else, how's everyone in your family doing?
We are holding up, hunkering down, as they say. So everyone seems to be okay. So good news on that front.
That is good news. Okay. Pensions and the ed fund.
So for the record, Graham Campbell from the Joint Fiscal Office, and I've prepared a document for the committee, and it lays out essentially the changes to the Vermont State Teachers Employee Retirement System. I would say the mechanics and the actual changes that are being proposed at the moment in the task force proposal, those things are not necessarily my bailiwick. Chris Roop, I think, can better explain those, what exactly is changing. I can walk through this document that I have for the committee that lays out those changes, but I think any questions should be directed to Chris. And it's my understanding that he will be here, shortly.
Yes, we do have Chris on the list. Okay. He is slated to be after you.
But I think what I can do for the committee is essentially lay out what this means for the education fund. So I guess I'll briefly sort of go through what is being proposed within the teacher's retirement system, and kind of breeze through those, and then get to kind of the overall impact on the education fund and the questions that this committee will have to address. So with that, there's a document online that
it is on our website.
Okay, and so just quickly running through what is being proposed. The first point that Chris always makes is that there's no changes being made to the pensions of current retirees and beneficiaries or terminated invested members. The first major thing is in 22, the proposal is to make a one-time payment of $75 million in general fund revenues towards the unfunded liability, using 50% of the $150 million reserved in the general fund from the fiscal year 21 budget, plus an additional $50 million in the general fund towards the unfunded liability. So we're sort of making very large upfront commitments using surplus money. The first major change in the ongoing normal cost for teachers' pensions is the COLA structure. So it amends the minimum and maximum amounts of any decreases and increases used to determine the net percentage of the consumer price index. So right now, it's my understanding that the COLAs are calculated on a min max of between 1% and 5%. So if the COLA falls between there, that'll be applied to the pension, but that's being switched to 0% and 4% in this proposal. It requires a member to be receiving a retirement benefit for at least 24 months prior to receiving a COLA, an increase from the current 12-month requirement. It increases the 50% of CPI COLA increase the 50% of CPI COLA formula by 7.5% each year once the pension system reaches 80% funded status. I'll let Chris better explain how that works, but I think it's more or less just how the CPI COLA is calculated for retirees. And it applies any increases to COLA members who leave active service on or after June 30th, 2023. So these, I guess, Chris could probably better answer questions about what those changes are. But what I would say is that these COLA changes result in net savings for the ongoing cost of teachers' pension payments, which is an ed fund liability at the moment. So keep that in your head. So it's savings for the ed fund, and partially for the general fund as well, because within the state payment for teachers' pensions, there's the normal cost, which is in the ed fund, and then there's the unfunded liability, which is paid for out of the general fund. So the COLA changes affect both. The next is an increase to the contribution rates for all active members. So more or less, my understanding is that this number is fixed depending upon when the employee was hired. I think it's 5% or 6.5%, depending on when you were hired. And what this does is it sets up a new contribution rate schedule depending upon the base salary of the employee. So, and it's phased in. So basically, those making between $0 and $40,000 in base salary will pay 6%, and it is a marginal tax structure similar to the income tax, such as those who are making over 100,000. On the dollars over 100,000, they will be paying 7.25% in year one. And then it phases in until eventually by year 3, those at the lowest level are paying 6.25, and those at the top are paying 9% on the salary over $100,000. So my understanding is that essentially the effective change here is that across the entire population of retired teachers, this more or less increases the effective rate by 1.5%. And this generates savings for the normal cost of teachers' pensions, which is in the Ed Fund right now.
Okay, so the employees are paying more, which means that we are paying for the employers at this point, or the we're paying it out of the employer's funds, which is the Ed Fund.
Exactly, right.
All right.
So it reduces our costs more or less in the Ed Fund.
Okay.
So and then there's the question about OPEB. So it's under the OPEB recommendation. So this is what the legislature, sort of the question about at the end of last session, sort of the difference between the House and Senate proposals on the budget and the yield bill, which was what to do with the normal cost of teachers' OPEB benefits, retired teachers' healthcare. Under the current system, it's a pay-go system. So basically, whatever the bill is for retired teachers' healthcare, we just pay it right out of the general fund. The proposal here is to set up a system, a fund similar to the pension payments, such that the normal cost is amortized over time and we make payments out of that fund. And so that would become a new ongoing liability for the education fund. So the first step, though, is to take $13.3 million from the education fund that's currently reserved. So at the end of last session, the legislature set aside $14 million for sort of establishing, for pre-funding OPEB out of the Ed Fund. And what this $13.3 million, as I understand it from Chris, is it sets up the fund basically, and it acts as sort of a one-time deposit into that fund to buffer against risk and volatility in the market. So you're essentially seeding this fund with $13.3 million. It's already reserved in the Ed Fund from fiscal year 22. And then the idea here is to then enact a pre-funding schedule into statute that charges the normal cost of OPEB to the education fund. And so that is roughly about a $15 million cost to the Ed Fund every single year, growing by about 3%, after fiscal year 23. And so more or less what you're seeing in this sort of OPEB recommendations line is, a new $13.3 million one-time seed funding or pre-funding into this OPEB account, and then an ongoing, about $15 million cost in the education fund.
Okay.
So
we're paying a little less in retirement contributions. We're paying less there, but we're paying more. Now, the last time I saw the spreadsheet, we had our contribution go from 6 to 30 million or 36 million because of the miscalculation on the investment rate of return. Are we starting with that $30 million base? Okay.
Yeah. So I think the section that's on this page, it's called the overall impact of the education fund, I think summarizes these moving pieces. So more or less the agreement introduces what I'm calling 2 new liabilities into the education fund, one of which is the one time and one of which is ongoing. And they're both related to OPEB, the retired teachers' healthcare. The first is that $13.3 million that's used to pre-fund, get this fund going. Then that's taking essentially surplus money and putting it into this fund that was set aside last legislative session. And so that's the one-time commitment. And then there's an ongoing payment every single year, starting in fiscal year 23 of about $15.1 million and growing by 3% thereafter. So this will be a new line in the education fund outlook, essentially, that's about $15 million a year. So the main sort of ongoing liability is that $15.1 million. But these new liabilities are offset by savings to the normal cost of teachers' pensions. And that item is already in the education fund. It's about $40.8 million in fiscal year 23. And if you have your education fund outlook, it's line 18. So this is we are already responsible for paying in the education fund, out of the education fund rather, about $40-ish million in the normal cost of teachers' pensions. And the changes to the COLA and to the contributions reduce the size of that existing liability within the ed fund. So the enhanced contributions are expected to reduce that normal cost by $6.2 million in fiscal 23. And once it's fully phased in, it will reduce that line item by $10.3 million. And the modifications to the COLA structure are expected to reduce the education fund's share of the normal cost of teachers' pensions by $1.6 million in fiscal year 23. And so if you take this all as a package, and this is the bold part of that second page, the net fiscal impact of these changes in the education fund are that one-time liability increase of 13.3. So you're taking that slug of money you reserved aside, and you're putting that into the pre-funding of OPEB. And then an ongoing net cost of $7.3 million in fiscal year 23 and decreasing to 3.7 by fiscal year 26. And on the third page, you essentially see those, four moving pieces lined up in a table. So the net impact is in fiscal year 22, we'll take that 13.3 and apply it to pre-fund OPEB. And then netting out the ongoing cost of teachers' OPEB with the savings from on the normal cost line, it's essentially the education fund will be picking up $7.3 million new dollars in liability. And as the contribution rates get fully phased in, that sort of swaps the new liability a bit more, or helps net off the impact a little more. And so by fiscal year 26, the new cost for the ed fund is $3.7 million. So I guess I'll close by saying that's, for fiscal year 23, so for the yield bill, in addition to all the other items that this committee will need to be thinking about, such as, what to do with $95 million sitting on the bottom line, what to do with respect to the governor's proposals about how to use that money, how much to potentially reduce tax rates. The committee will need to discuss, whether it wants to cover, if this proposal is enacted into law, how the committee would want to cover that $7.3 million in fiscal 23. Okay. Will it want to do so through tax rates? Will it want to apply some of the one-time money? So those are the kind of things that if the pension proposal passes, this is sort of what the committee will have to think about, is how to cover that cost.
Okay, so we've got to cover that cost, the 7.3. And the governor has proposed to use the surplus in two ways, if I heard it correctly. One is to do a rebate, so we don't get into the annual fight of, but if we reduce your tax rate 3% this year and then have to go up 5% next year, you're not going to thank us. So he's going to send everybody a check, amount yet to be determined or how it's figured. And then the other half, he's proposing to invest in technical education, how has yet to be described. So if I understood what I heard today, the governor's budget includes full funding of the pensions as it has every year, but nothing with this agreement. I think what they said in the briefing this morning was they look forward to working with us on that. But that means that we will have to, anything that's a cost here, if this is, this agreement, that will have to be come out of the governor's proposal or somewhere else. Have I got that? Is that your understanding, that he hasn't figured any money for this yet?
My understanding is no, there's nothing from what I've heard from the administration. There's nothing that, proposes ways to cover this,
Right.
largely because this is, something that came out of the pension task force as part of the legislature.
Yet.
It is not law. And so you're right, the governor has proposed using half for a rebate program, half for CTEs is my understanding. But so if all of that money were spoken of, the bottom line, that 95 million were spoken for in between those two proposals, then if the legislature agreed with those two proposals, it would need to, find or put the $7.3 million onto the tax rate.
Right.
But again, there are many moving pieces, going forward. The yield bill will come over from the House likely with a proposal on how to, if this becomes law, how to cover this and what to do with one-time money. So, but it is, I think we're discussing it today just to sort of give the committee a heads up about a potential new liability within the ed fund.
As I said this morning, we are doing an income tax, a corporate income tax change under a bill for feminine hygiene products. It just doesn't get much stranger than that. And we'll find a way to deal with it. Questions for Graham right now, and Chris Roop is here. So Chris, jumping around. It was you, and now it's Senator Sirotkin. I've got a couple questions, and Chris, I'm going to give you the floor, and feel free to jump in too at any time. So Senator Hardy.
Thank you, Madam Chair. Graham, I don't know if this is for you or for Chris, because it's actually a question on the bullet points just prior to your section on OPEB recommendations. You may have explained these two bullet points and I just missed it, but the last two bullet points, and they're actually about the general fund, amend the general fund year-end surplus construct to reallocate 25% to the teacher's pension underfunding. I don't quite understand that. And then the one before it, and I'm wondering if one of you could just explain those two bullet points.
Sure. I could take a stab at that. For the record, Chris Roop, Joint Fiscal. I apologize for being late, Madam Chair. I was double booked this afternoon. But...
No, that's understandable, and it will only get worse.
Well, I'm not working off of the exact same document that you all are working off of, but okay. I can explain the year-end construct. Right now, you have a provision in the law that says 50% of your unreserved, unrestricted general fund surplus goes to the state employee OPEB trust. Last year, $52.4 million went over to the state employee OPEB trust through that construct, which is more than enough one-time money to begin a pre-funding schedule. The recommendation from the task force, the unanimous recommendation, was that you take that existing 50% construct and moving forward, split it equally. So 25% would go to each of the different pension systems to further accelerate the pay down of the unfunded liability. So that's what that language is. It's not committing anything above that 50% chunk that's already restricted. It's just taking it, and instead of putting it all in the state OPEB, instead redirecting it 50-50, or I should say 25-25, into the two different pension systems.
Okay, that is helpful. And then the bullet point that maybe you can't see, Chris, before that is beginning in FY24, codifying the state's intent to annually fund. Can you explain that one?
Sure. So the intent is that as part of the deal, or as part of the recommendations, that the state would commit to a level of funding to the pensions above and beyond the actuarially recommended amounts until the pension systems reach 90% funded. So you're going to hear us colloquially call this the plus payment. So every year the actuaries will recommend an amount of money based on where the fund is for what we need to pay for our amortization payments going forward. The intent here is that beginning in FY24, a plus payment would be made and ramp up by FY26 to be $15 million. And that $15 million plus payment would stay in effect till the pension systems hit 90% funded. What this effectively does is take some of the savings that would accrue to the state from some of these changes and the application of the one-time $200 million and essentially reinvest that savings into further paying down the unfunded liabilities. And when you make those extra payments, it's almost like if you make an extra payment on your mortgage, but assume that your mortgage is recalculated every year. So the more you pay above the actuarially recommended amounts in the near term means in the future, your payments go down a little bit. So you pay more now to save a little more in the future.
Got it. Okay. Thank you. Very helpful.
We've been doing that for a while. And Chris, I don't know if you know the history. I don't, but I know that at some point, we established the teachers' healthcare system, but we never capitalized it. We just paid it out of the pension. And the Treasurer Pierce came in and said, oh, this is not good. And we borrowed money from ourselves to start capitalizing it.
Correct.
And now we're further capitalizing it. So eventually, we're going to get enough return on investment to start offsetting some of those costs. I didn't realize until listening to the briefings on the pension, I knew we were undercapitalized in the teachers' OPEB. I didn't realize that we were more seriously undercapitalized in the state employees.
That's exactly right.
And I don't know what we've been doing. This has all been in the general fund. So it's been kind of outside the purview. And it was just one of those things that happened every year, except when we found out we couldn't keep underfunding. They changed the accounting standards, and we have been paying every cent we can since then to buy down that obligation. And so we're talking about the past underfunding obligation, which the general fund will continue to pay. Plus, we have an underfunding in the present system because people are living longer. And at this point, we've got more retirees than we've got working people paying in. And so that cost has gone up. So we've got two sets of underfunding. Have I got that?
No, that's right. And if I may sort of elaborate a little on your history, yeah, what you're referring to is up until about 2015, the state had been paying the pay-go cost of retired teacher healthcare benefits out of the corpus of the pension fund. So even though the state since 2007 had been fully making its actuarially recommended ADAC payments, this had a similar effect as if we were making a contribution shortfall. So this was a contributing factor to why the state pensions have a bigger unfunded liability than the state. It is not by any means the reason why. Legacy underfunding of the ADAC before 2007, plus those OPEB practices that we stopped, contributed less than a fifth of the problem to the pension system. But the way we are doing things moving forward is what we call a pay-go basis, where every year you're essentially appropriating the dollars to pay for the healthcare benefits of today's retirees as they become due. So on the teacher side, you see a line item in the general fund where that's paid out of. On the state side, this cost is embedded into the appropriations of all the funds of state government that employ the active workforce. So every fund pays, the retirement rate right now is 25.5% of payroll. Out of that 25.5, 19.5 goes to the pension, the VSERS pension. The other 6 pays the pay-go cost of the state employee OPEB benefits. So that cost is borne by all the funds of state government in proportion to their share of the active payroll. So it's kind of a hidden thing. There's not like a one line you vote for it. But what we haven't been doing is pre-funding the benefits. So this recommendation brings us to pre-funding the benefits. All we've done really is we've set up the trust accounts. We've put a little bit of money in. We've made sure, and that was the loan construct that you referred to, Senator, from a few years ago. But we have continued to just use that fund to pay the bills as they become due for today's retired members. What pre-funding is really all about is setting aside more money over the course of an active member's career. And that's what we call the normal cost. So that you pay that amount of money, and by the time somebody retires, there will be enough money at the end of that, big enough pot of gold at the end of the rainbow to pay for the benefits in retirement that member earned. So that is the key part of the obligations that we have never been funding, is we have not been pre-funding the future benefits earned by today's workers. So this is something that the rating agencies notice whenever they look at our balance sheet. Everybody notices it when you look at our balance sheet, but pre-funding in and of itself, adopting your pre-funding schedule into statute and adhering to those higher appropriations in the near term that you need to stick with it, that in and of itself would lower our unfunded liabilities by over $1.7 billion. So add in the pension related changes, and we're looking at over a $2 billion reduction in the state's long-term liabilities, which is tremendous for a state this size. And you're shoring up retirement benefits for the workforce in the process.
Okay. Other questions? Okay, Senator Brock. No, Randy, you're muted.
As I read the document, it seems to suggest that the goal here is to create a pension plan ultimately that is 90% funded. Where did the 90% come from?
That's a great question. So the actuarial math is all predicated on you getting to 100% funded. So when the actuaries figure out what your ADAC is going to be, it's all about getting to 100% funded by a fixed date. But 100% is not necessarily the benchmark of a system being healthy. There's a lot of nationwide experts that would consider any plan that's at least 80% funded to be in relatively good shape. Why 90% was picked is it would mean that the system is in a healthier shape than if it was at 80. But if you're at 100%, pension systems don't typically stay at 100% for very long. You're always going to have actuarial gains and losses from year to year. And I think one of the intents is, and also if you're over 100% funded, I'm not saying anybody in Vermont would ever do this, but as a relatively new Vermonter coming from a state who did do this, when you have a system that's over 100% funded, it's very tempting for people to make decisions that might be attractive in the short term and not attractive in the long term. So that sometime, I'll use my home state as an example. The systems were fully funded at the beginning of 2000s, and a very large retroactive benefit enhancement was passed. And now the systems are barely 60% funded because people thought at the time that double-digit returns would continue forever and that they could afford that enhancement. It was also tempting for people to short the actuarially recommended payments, saying times are good, we don't need to do this. If you're at a system that's
we
100,
got in trouble.
a lot of places have.
Yeah.
So when you're at 90%, you avoid the yo-yo effect that can happen if you're at 100.1 one year and then an actuarial loss just brought you down to 99 the next year. Like, how do you plan your appropriations like that long term if it could vary from year to year? And if you're in a system that's 90% funded, you're not going to find too many analysts on Wall Street or really anywhere in the public sector world that will say that you have a huge crisis on your hands. If you have a system that's 90% funded, you're in good shape, and for it's very likely that you can afford the payments that would be required to bring you from 90 to 100%. And that would be, if we can get to 98% anytime soon, and the actuaries expect it would be in the mid to 2030s under status quo, the system would be in just tremendously better shape than it is right now.
Well, I guess the question that comes to mind, though, is wouldn't it be in even better shape if the target, because again, it's 90% is a target, it's not an actuality. If the target were 100%, which one would understand is what pension systems ought to be doing in terms of setting a target. If we get to 90% in the mid 30s and we find that, well, we're at 89 or 87 or 86, is there a mechanism in what we're doing now to change the contribution to get it even to the 90 target?
Sure. So the contribution right now is always calculated to get us to the 100% target. The only thing,
annualized basis, words.
Correct. The only thing that's different is that the plus payment would go away once the system hits 90% funded. Beyond that, the actuaries would still be recommending a payment every year that gets us to 100% by whatever target date we have in place at the time. It's currently 2038, but if we're in 2036 and the system's 94% funded, or you have an economic situation happen, it probably makes sense to consider revisiting the 2038 date, as long as you can afford to do so. It doesn't make sense to do it now as much, but the math will always point you to 100%.
Okay. Senator Hardy.
Thank you. Chris, a question and a clarification. What are we at now? If the target is 90%, what are we at now?
That's a great question. I thought you would answer it, or you would ask that. So the numbers for the teachers or the state employees as of the end of fiscal 21, you're at 67.6. And the teacher system as of the end of fiscal 21 is at 52.9. That is on an actuarial basis. So that's based on the smoothing that we do with our investment returns. So you don't recognize all of your investment gains and losses at once, because if you did, things are just so volatile from year to year that you would never be able to plan your budget process in order to fund your ADAC payment. So what they do is they smooth the gains and losses over a 5-year period. So that value that I just rattled off reflects on the smoothed asset value. We had a very, very good year in FY21. We had a 24.6% preliminary return across the VPIC portfolio, but most of that was not recognized in the math in FY21. We will recognize more of that gain in future years. We entered FY21 with deferred losses of 180 million. So this really strong year wiped out the deferred losses and gave us some deferred gains that need to be recognized in future years. So if all else is equal moving forward, I expect you'd see those percentages creep up a little bit more in the next few years as more of that gain gets recognized. But again, that's assuming all else is held equal, and all else is never held equal. We're not going to have a 24% return this year. My crystal ball has a big crack in it. It doesn't work too well, but I'm going to bet based on how things are going with the market, we're not going to get a 24% return again next year.
Okay, so 67.6 for the state employees.
Correct.
And 52.9 for teachers.
Correct.
I think you said teachers for both of them. So I just
Oh,
wanted to
I'm sorry. The higher values.
Okay.
Higher
I could have
values
misheard you. So my second that was my question. Now my clarification. You were saying the current target is 2038 for the 90%. Do you mean current
100.
For 100%? Excuse me. Right. You clarified that with Senator Brock. Do you mean the current target under where we are now, or where the pension task force has proposed we go?
Where we are now. So this is set in statute, that you have what we call a closed 30-year amortization period. So this began at the start of FY09 and ends at the end of FY38. So what
does that change under this proposal?
It does not.
No. Okay.
It does not.
Okay.
So the math will point you to, the actuaries will point you to, every year they'll give you the recommended amounts to get you to 100% funded by FY38. But the year you hit, 80 or 90% might be sooner than that. But it's set in statute right now, and you all would have to change it to extend that date beyond FY38. And the impact of that would be like, refinancing your mortgage and adding length to it. Your payments might go down a little bit, but you're going to pay much more in interest costs, and you're going to pay it for longer.
Okay, so this proposal doesn't change the timeline. It just changes the amount of money we would have to put into the system to actually reach the goal of 100% funding by 2038.
Of reaching 90% funded.
90% funded. Okay. Great.
We're going to have to wrap this up because we are seriously behind, and we have a presentation. Jill Remick and Jake Feldman are here, and I have to leave for a chairs meeting in 7 minutes. So Senator McDonald will get to walk you through the common level of appraisal. So thank you, Graham and Chris. And we're going now back. And Jake and Jill, I see everybody. There's Jill. This is a way I could put the presenters at the top of the screen. I apologize. I do have to go to a chairs meeting at 4. I am getting prepared to object because things cut into afternoon money committees more than morning committees. So I'll be snitty about that, but think you're going to walk to us up, Senator. Oh, Senator Brock has to go too.
As does Senator Sorokin, Madam Chair.
Ooh. Well, maybe we will have Faith send a
As the
little
Senator
text
Bray.
to that. All right. So we're gonna.
I'll talk to myself, Madam Chair.
We won't
Yes,
have
that
four-
would be good. I'm sure you could handle that.
Yeah. No arguing.
I'm not,
It would just
I'm
be me
not
and
sure
Mark.
what we're gonna do.
I'll be
'cause
here.
If we all don't go, then there is no chairs meeting. Faith, can you drop a text and see if they can put the chairs meeting off for 15 minutes?
Sure, to Carolyn,
Yeah.
I will do that right now.
Thank you. And we'll start and we'll see how far we get. And Jill and Jake, I don't know what, this is your show. So start. And if we don't finish, we'll have you back another day.
Did we just trump all the chairs of the Senate committees?
I obviously don't remember that either. So
My name is Jill Remick. I am the Director of Property Valuation and Review from the Tax Department. And I'm joined by Jake Feldman.
Jake Feldman, Senior Fiscal Analyst at the Tax Department.
okay.
So I do have a very brief PowerPoint presentation to just sort of keep us on track. We're here to talk to you folks about the equalization study that we just finished this past, as of December 31, and the resulting common level of appraisal, the CLAs that have come out, and sort of providing some context for those pieces. So I'm going to see if I can share my PowerPoint. Here we go. All right, I'm hoping you folks can see my screen.
Yeah, and it is on our website if you can't.
Great.
But I can see it without my glasses even, so that's good.
Good. So as you folks are, I'm sure aware, every year we have a statutory requirement to complete the equalization study. We work collaboratively with all of the towns to review sales. And essentially the results of the study are used to apply a tax rate factor to each of the tax rates at each of the towns to ensure that we're reflecting fair market value. So what these numbers tell us is basically, where the grand list values are in a given town versus where those similar properties are in the fair market value. And so The equalization study is done over a 3-year window. We look at property transfer tax return data during that 3-year period. We do throughout, obviously, any returns or sales that are not arm's length or otherwise may not be useful data for the study. And we review those. The towns review the sales on their end, and then we do one final check on our end. So we've heard a lot of concern over the last few weeks, and certainly heard it even this fall. I know a lot of towns were very nervous about the results of the study because they could see the properties in their given towns just not even making it on the market before they were sold, and a lot of them selling for cash or well over value. So a lot of towns were anticipating rightly that the CLA, so that factor, would actually be dropping. But we wanted to sort of provide a little bit of context and some things to keep in mind before we sort of dig into the data. So essentially, it's important to keep in mind that education spending increased at a normal rate. It did not increase at some gigantic rate that would also be reflected in tax rates. So while the CLAs did definitely drop, meaning that we needed to boost up those tax rates to reflect fair market value, the overall demand on the ed fund and demand on taxpayers did not jump at that same rate. The yield recommendation in the December 1 letter increased because the grand list has increased in value significantly. So this means that Vermont tax rates and actual taxpayer bills are not going to jump exponentially, which I think is what a lot of folks were worried about. Some might even decrease. So for example, here in Montpelier, we are Montpelier Roxbury School District. The CLA adjustment for the Montpelier residents and the CLA adjustment for Roxbury actually led Montpelier's tax bills are actually going to drop about $27 on average for $100,000 worth of value. And in Roxbury, they're going to go up a little bit. And we'll get into a little bit more of what that really means in a minute. It's also really important for folks to keep in mind that real estate swings, to the extent that we have seen, which has certainly been substantial, have happened in the past and are normal in times of significant national economic factors. And also, of course, that Vermont is not unique in this situation where we have a very low supply for very high demand residential property market. So some of the things you can draw conclusions on from these results is that Vermont's in a favorable position in that we have robust property values, and our education fund, as you folks know better than anyone, is in a good situation. I think that this is actually, the results of this study are one of the single most important things for the legislature to keep in mind in talking about advocating for housing. Housing is an incredibly high demand in Vermont. We don't have the stock to satisfy the demand for both in and out of state Vermonters and buyers. Many towns have had their grand lists pretty darn stale, and this exacerbated that. So that means that they may not have their grand list that they have their values set at in their town have not been revisited in some cases for over a decade. And so if your grand list was already stale and your CLA was already dropping, then this certainly exacerbated that. Obviously, real estate transactions are selling for way over their listed value in a lot of places. Certainly this is not equal across all towns in Vermont, but and we'll get into the details of that more, but there are certainly pockets of the state where the demand is incredibly robust. Another thing I think is really important to keep in mind, as we were hearing a lot of concern from towns about the CLAs dropping, is the CLA is doing its job by applying that factor to the tax rates to make sure that folks are assessed based on fair market value. Let's see here. So I think Jake's going to explain a little bit more about sort of what we're looking at and what the trend has shown in the data.
Yeah, thank you, Jill. Jake Feldman, Senior Fiscal Analyst at the Tax Department. I read a Times Argus article last week that said that the equalization study is a comparison of what people list their values for when they go to sell them, like, you know, on Zillow or something, compared to what they sell for. That's not true. It's a comparison of the grand list value for properties that sell to what they actually sell for. And what the equalization study does is it looks at sales during a 3-year window. It's a ratio study, and it takes all those ratios and puts them together and figures out an adjustment factor for the town. What Vermont does is an example of indirect equalization. What we're adjusting is the tax rate. There are certainly ratio studies where they actually adjust the value, but what we're trying to do is just find a general factor to make sure towns are sending their fair amount to the education fund. So a ratio less than 100 means that a property is sold for more than its fair market value, or more than its listed value. So if it's listed for 100 and it's sold for 120, that would be 80%. And this graph here is for the entire state, the aggregate ratio. So you add up all the listed values and divide by all the sale prices, and it's divided by a quarter. And the most recent equalization study that PBR just wrapped up in December looked at sales between March of 2018, April 1st, 2018 and March 31st, 2021. For a while before COVID, we were, improving, ratios were going down, it was a good, solid real estate market. Starting at COVID, which is basically the last year of sales that we just added in the equalization study, things got really hot. Properties were selling for much more than they're listed for in the grand list, consistent with what you've probably been reading about in the news. And the effect that has is it makes towns, CLAs go down. And that is pretty much true statewide. Obviously, the market has been hotter in some places than others. And Jill and I put together a big list for you to look at if you want to see individual towns. But it's pretty much statewide hot market. So bringing in that most recent year of sales has decreased towns' CLAs for the most part from where they were in FY22. And I think we could take a look at the next one. We like to see CLAs that are close to 100, which means that property in a town is, assessed pretty close to its fair market value. That's a healthy grand list. When it's less than 85% or more than 115%, so CLA is less than 85 or more than 115, that actually triggers a reappraisal order from PBR. And those are kind of like the extreme numbers that are not healthy, indicative of a healthy grand list. You can see here from our last 5 equalization studies that things have moved from the middle towards the lower CLAs. This year, in the equalization study that we just wrapped up, that's going to be the CLAs that happen in July FY23. We had 24 towns that had less than 85%, and 85 to 100% also ticked up a lot. And then the higher CLAs, there were fewer of those. So that's a movement consistent with the graph that I just showed you towards lower CLAs. And then this one is a reminder about how tax rates are actually calculated. In the legislature and on the tax commissioner's December 1st letter, we only talk about equalized rates. But what people see on their bills is not equalized rates, it's actual rates. And probably for the most part, 99.9% of Vermonters have no idea what an equalized rate is. So the way you get an equalized tax rate is you take the per pupil spending and you divide it by the property yield number, which is going to have to be decided this year as it is every year. But then that number you divide by the CLA to get the actual tax rate, which shows up on the bill. So Montpelier, where Jill and I live, The current year that we're in, FY 2022, I guess we're spending 16,956. The yield passed last May was 11,317, and the CLA was 84.44%. So those are the ingredients. You divide the per pupil spending by the yield to get the equalized rate of 1.4983. And then you divide that by the CLA to get the actual tax rate that Jill and I see on our bill. For non-homestead property, that's any property that's not a homestead, like a business or a factory or a second home. That's the statewide non-homestead rate, which is the same for every town, but it gets adjusted by the town's CLA. And that's where the non-homestead rate comes from. Also, if Jill or I had an apartment or a business attached to our home, that would be charged the non-homestead rate.
Okay, I haven't heard anything from the chairs from leadership, so I think we're going to have to wrap this up.
Senator Cummings,
Yes.
chair's meeting will start at 4:15.
Okay, so it's 4:08. Let's see how fast we can do this. And I apologize, but
Madam Chair, I do have a question if you're
Yes.
ready.
yeah,
I wonder if you could just talk, if the witnesses could, either of them could talk about what happens like in Burlington. Obviously, we had a high profile reappraisal and values climbed significantly for a lot of people. And then the first property tax bill is due in August. So it's a budget that we established under the old values. Does the tax department, does the CLA sort of get corrected midway through the school budget year under a circumstance like that? Could you just talk about the timing dynamics?
Yeah, sure. Actually, this relates to my next slide. So Burlington did do a reappraisal as of April 1st, 2021. And we did spend a lot of time helping people in Burlington who were confused about what was going on last summer, the summer of 2021. So what happened there is they did a reappraisal as of April 1st, 2021, and that they got something called it's basically a CLA calculated in a special way. It's their listed value from their reappraisal divided by PVR's estimate of total fair market value from 2020. And it made, and this is actually on that slide, their CLA went up from 74.77% to 105.32%. So it went way up. And tax rates went way down because remember, you divide the equalized rate by the CLA to get your actual rate. So starting Senator Pearson, July 1st, 2021, the actual rate on people's bills in Burlington was a lot lower than it was the year before. Their listed values went up generally. We have heard that the residential side appreciated more than the commercial side. But as a reminder, the tax rates went way down. You put those things together, and this is getting into the issue of income sensitivity. You put those things together and the credit from the prior year may not have like covered them as much as they wanted. If their property listed value went up by 42%, then the credit was actually fine and totally consistent. But if the property value went up by more than 42%, that's a situation where we were getting calls about, how does income sensitivity work and why is it not sensitized? So that's what happens in a reappraisal. And I should also mention, and Jill might want to say more about this, that it had been 16 years since Burlington reappraised. And that's a long time for a major city with a, active market and a lot of properties. So that caused some of the big swings that we were seeing.
Thank you. That helps.
Okay, thanks.
Okay. So at this point, what we're seeing is property values are going up, common level of appraisal is going down. But when normally, okay, yeah, because normally when you do a reappraisal, it's supposed to be you're going to pay a lower tax rate on a higher value to raise the same amount of money. All things being equal, only all things are never equal for everybody. So there will be some winners and losers, but there should be a self-adjustment factor in there, depending on what your town's budget is and what the school budget is.
Mm-hmm.
Okay. Senator McDonald. You're muted, Senator. There you go. Now we can see you and hear you.
The 13 years is, I believe, an unusually long period of time, and I believe because of the recession of 2008, when property values fell, that the adjustments were delayed and not necessary because they hadn't gotten out of whack. Is that correct?
Well,
Let me rephrase the question if that we're having trouble with that you could usually count on having to reappraise every half dozen or perhaps 8 years if you were careful with your coefficients of dispersion. But because of the drop in property values in 2008, it's been a particularly long time between reappraisals throughout the state, including Burlington. Is that correct?
Yeah, that certainly might be one of the factors. I know it's really difficult for towns, even when they're ordered to reappraise, to find a firm to do that work. So sort of, the national best practice is, 5 or 6 years, you're going to want to reappraise. It's going to get stale pretty quickly. And 10 years is really not ideal. And we have a lot of Vermont towns that are more than that. So I did include in your documents, there's a PDF, but I have an Excel as well that I'll send along if you want to take a look. There's quite a disparity. There's quite a lot of swings and a lot of time for a lot of towns between reappraisals. And so that really caught up with folks. And a lot of towns are in the middle of it right now and are kind of wondering what does that mean? Are they now reappraising at a high level, and is that going to hurt them? And not necessarily, it's not that simple. There's no maximum amount of time in Vermont statute for towns to reappraise. There are the reappraisal orders. So the towns that their COD goes above 20% or their CLA is below 85 or above 115. So we do issue reappraisal orders every year. But again, then the town is essentially waiting in line for a few available contractors to do that work. So what we need
Please explain COD.
Sure. So the COD is the coefficient of dispersion. So in the sense that the CLA is a townwide adjustment, the COD is disparity between categories. So if your COD for residential stays within under 20 as far as disparity across that category, but maybe your commercial has a lot wider, then that could signal a reappraisal. So that's breaking out across category or within a category, the disparity of valuation in a particular kind of property within the town.
Okay, we're going to have to wrap it up. So thank you very much. I apologize for the squeeze.
Not at all. Thanks for seeing us.
And we will see you all again, I know, before we get through this. Right. So non-chairs, enjoy the rest of your evening. The rest of us are leaving now. So thank you.
Thank you for your time.
Okay, thank you, Faith. We are now going